Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Thursday and it's the 3rd of August. My name is Russell Shaw. I'm a senior market specialist at FXCM. Just want to draw your attention to my email address, which is rshaw@fxcm.com. If you need to correspond with me, that is the address to use. Going to go ahead and bring up our disclaimers. We'll start off with the high risk investment warning. Good morning, Zanetta. Welcome. Thank you very much for joining. It's a pleasure as always. Good morning, Kim and Raj. Thank you for signing in. Highly appreciated. Thank you, everyone, for joining this morning. It is highly appreciated. All right, I'm just going to keep the high risk investment warning on screen for a few more moments. All right, let's just bring up our market commentaries disclaimer. Right, and just the references, MarketScope and TradingView.com. And let's go ahead, bring up MarketScope first. All right, starting off with the US dollar. So yesterday we introduced a template, which I'd like to use, but it introduces some interesting complexities or ambiguities. I want to show you in a moment. It's going to take time for us to resolve these. And the first thing perhaps to take a look at is just on the weekly chart. We've put in our peaks and troughs, and we've asked, is this the lower peak? And I've put a question mark there, because if it's a lower peak in the US dollar, then the downtrend continues. Okay, but yesterday, what we did is we added just a few indicators. I'll change this to the weekly. And just to reiterate what we added a 5 period green exponential moving average. We added a 10 period exponential moving average, which is orange. And we added an RSI. I just want to just show you, excuse me. I just want to show you the settings for the RSI because they're slightly different to your standard defaults. And you can see I'm using a 10 period. And if you go through to the data source, I'm using the median. So how's that different from the default? The default is usually 14 and calculated on the close. This 10 median seems to work well for me. It's a slightly smoother type of RSI, and I'm using the 20 and the 80 as the overbought, oversold, slightly different to the default. Now, what's interesting is the EMAs. Okay, the EMAs. Now, we just need to understand something about moving averages. They are classified as trend following indicators. That means they work when there are trends. When there's no trends, they tend to give what we call whipsaw signals. And you can see the whipsaws over here. We have a bullish crossover there. We have a bearish crossover there. Again, a bullish cross. I'll just put sort of a bearish crossover here, which is quite sort of quite an elongated signal. I'm going to just do it as such. What we have now, okay, is actually looks like a bullish cross, and that's where the ambiguity comes in. Let me just keep the last ellipse. Okay, that's where the ambiguity is. Let me just explain why I think it's an ambiguity Okay, if we go back to the weekly chart where we're looking at peak and trough analysis, we're looking potentially for a lower peak. In other words, for the downtrend to potentially continue. Now, I know that we don't have the LP, that's what's LP question mark, but we go through to the template that we've introduced. It's actually a bullish signal. Okay, so we're going to have to see how this plays out. I'm going to use the moving averages and see if we do get a higher peak here. What I do also notice is that the RSI is popping above 50. Now, another nuance with the RSI is where is it relative to the 50? If it's above 50, it's generally regarded as an underlying bullish momentum. If it is sub 50, it's generally regarded as having a bearish momentum. So kicking up to a slightly maybe bullish side. Again, I want to draw your attention to the fact that it's not really biased in terms of its position. It's oscillating around 50. So perhaps more of a trading range here more than anything. What subsequently happened with the dollar is that it's a safe haven. And with the Fitch downgrade from AAA to AA plus, a lot of money has rotated into the dollar as a safe haven. So we just have to see how that plays out. I don't think that the Fitch rating downgrade has got any sort of long-term ramifications. I really don't. So it's going to be interesting to see how the EMAs behave from this particular point. Okay, let me just see if there's any questions coming in. Hello, Howard. Good morning to you. Pleasure to have you on. Godwin just asking for the RSI parameters again. Godwin, I'm going to show them to you. Just take a look at the RSI and see if these work for you. Okay, there's no magical sort of settings here. I use a 10. Okay, 10, and I use the median. And we've been using that for quite a long time now. It seems to work quite well with the way we read the RSI. Okay. Now, another nuance that we introduced yesterday was a complete top-down analysis, When I say a complete, generally we've been looking from the weekly going down. I'm suggesting now we go from the monthly and work our way down, where we're actually looking at the monthly as the primary trend. So if I bring up the US dollar monthly, it seems to cement the trading range hypothesis. Take a look. The trend following indicators have squeezed together, right? They've squeezed together. So there's a sideways movement here. If you take a look at the RSI, it is above 50, but it's very close to 50. It's very close to neutral. So it does seem as if US dollar, by and large, moving sideways. That's problematic. US dollar moving sideways is problematic because it tends to lead other financial instruments. It's the first in a line of cause and effect. What happens with the US dollar tends to filter through to other instruments. It's not hard to understand why. If we look at euro US dollar, well, the US dollar is the denominator. If we look at pound US dollar, dollar is the denominator. Even if we look at gold US dollar, dollar is the denominator. So clearly the dollar is an important instrument for us to consider. The fact that it's moving sideways means that that denominator side is moving laterally. So if the dollar side is moving laterally, a lot of the movement is going to be determined by the numerator side. Let's take a look at the weekly again, just do a top down. So here it's moving sideways. I feel that is problematic. There is a number of whipsaws on the weekly. That just is a symptom of the fact that the monthly is moving sideways. We want to see how this latest crossover is going to be resolved. If we go down to the daily, okay, we do have dollar strength. Okay, you can see that we've got the dollar strength. So the current sentiment is dollar strength. Now remember, okay, remember, dollar is a safe haven. So if a safe haven's receiving strength, okay, well, that means that the risk markets potentially are fragile. Potentially are fragile. Let's go to the S&P 500. Okay, we're going to do a top-down analysis here as well. We'll start off with the monthly. All right. So the S&P 500, just take a look at the crossover here. Here's the golden cross. I just want to fix up my ellipse. It keeps going into the background, so I want to untick that and set as default. Okay, much better. Okay, so we've got the golden cross with the green 5-month exponential moving average above the orange 10-month exponential moving average, bullish, showing angle and separation. That's another tick for the bullish check boxes. What about the momentum? The momentum is biased. Which side is it biased towards? It's biased to the positive side of 50, the upside of 50. That is bullish. So by and large, the primary trend of the S&P 500 is to the upside. Okay, if it's to the upside, let's see if we can get some sort of synchronization with the S&P 500 weekly chart. Okay, so now we go down to the weekly. The weekly is showing something interesting. Okay, there's no doubt that we're moving in that northeasterly direction. So that is synchronized up with the monthly. There is also a positive RSI. It's above 50, but there's a problem here. Okay, there's a problem here. What is the problem? It's the overbought condition. Okay, above 80 is overbought. So I think that the primary trend of the S&P 500 is up, but I think that we are at a stage when we can consider pullbacks. Pullbacks in uptrends are dips in uptrend. They're potentially exploitable. Okay, so I think that the overbought condition here in the S&P 500 is problematic. Now remember, we saw that the US dollar was moving up. The US dollar is a safe haven. We go down to the daily. It's not surprising we've got a bearish cross down here. Okay, so it could be that the overbought condition is starting to normalize. It makes for quite a confusing situation because we're all over the place. When we're all over the place, we want to default back to the primary trend. Why do we want to default back to the primary trend? Because it's the primary driver of trend direction. S&P 500 is moving in a bull trend, but okay, we are entering into an intermediate corrective period. It seems, well, if we're moving into an intermediate corrective period, then we've got to be very patient and we've got to be quite nimble and savvy here. And the reason that you want to be nimble and savvy is because you want to try and catch the pullbacks. Catch the pullbacks. All right. We also want to see what happens with the US dollar. Does the US dollar continue moving sideways? If it continues moving sideways, remember, that's problematic. Okay. So a potential correction in a bull trend. Let's just take a look at one more. Let's take a look at Euro US dollar. Again, we're going to do the top-down analysis. I'm just seeing the questions here. The EMAs follow the price. They do not predict the price. That is true. That is true, but we're not talking about prediction here. Okay, we're talking about trends. We're talking about trends. Okay, if there's going to be a trend, then the trend following indicators tend to work very well. Okay, so take a look at the S&P 500 here. There's a bullish cross down here. Did we know that there's going to be a bullish move? No, but there's a bullish cross. Okay, turns out that there's a trend, but the trend following indicators allow us to keep with the trend. There's no ways we can predict. We're not determining any sort of prediction. What we're trying to do is we're trying to follow a logical process from the top down. Okay, from the top down. From the top, we have a relatively slow moving chart, which does indicate that we are in a bull market. By the way, the definition of a bull market, the technical definition of a bull market, is 20% off of the bottom, plus 20% off of the bottom, off of a low. That's been met. Okay, so there's multiple ways of defining the bull trend. The other way to do it is just through peak and trough analysis. So we can do it as trough, peak, higher trough, higher trough, higher peak. There's your bull trend on the monthly. The EMAs are just another methodology of gleaning that sort of information, Kim. There's no ways we would ever predict, okay, the market. All we can do is react. All we can do is react. Okay, so the fact is that we've got a primary bull market here. Well, if we've got a primary bull market here, okay, well, our model also suggests that there are ebbs and flows within the primary market. Well, if there are ebbs and flows, okay, we're not predicting ebbs and flows, we're suggesting that there possibly are going to be ebbs and flows. Well, then when we get a corrective move, that's potentially a dip in an uptrend that's exploitable. Well, if it's potentially exploitable, we've got to develop some sort of way to exploit it. Well, we can use the EMAs. We don't have to use EMAs. We can use reference candle reversals. Okay, so the idea here is that we're not predicting. Okay, we're certainly not predicting. What we're doing is we're reacting. We're reacting to the fact that there is a primary trend. We're also reacting to the fact that there is an overbought condition. We're also reacting to the fact that it's starting to pull back within an uptrend. But if you look to the left, sellers come in, so they can come in now. Kim, just you have to flesh it out for me. If you look to the left, on what time frame? On daily? Just a little bit more information. Are you looking at the daily, the weekly? On the weekly, okay, let me just go back to the weekly. Okay, and if you look to the left, there are sellers. So can they come in now? Okay, so Kim, I think, just correct me if I'm wrong, you're looking at the resistance areas. So you're looking, say, here at resistance. Okay, you're looking, I think that's what you're saying, is that, okay, so yes, there could be selling here, but the idea here is, okay, again, top-down analysis. So yes, there's resistance. I see the resistance, okay. I also see the fact that we're moving in an uptrend, okay. The fact that we've hit resistance perhaps gives a greater chance that we get a pullback here, and then we get the movement up, that we get the pullback here. I don't know if we're going to break above to all-time highs. What I would suggest, okay, that is long as GDP, gross domestic product, is positive and there's growth in the economy, effectively all-time highs do seem to themselves become fragile and drop away. So yeah, there is a resistance. I can't deny that. But the cornerstone of the methodology is trend analysis. There was resistance over here. Okay, there was resistance over here. Eventually it fell. Okay, because the trend was strong enough to overcome it. Then that resistance turned into support. Okay, what support and resistance effectively is? Let me bring up Microsoft Paint. Okay, so what you've got is you've got a point in time. So let's just say somebody buys at this point, somebody goes long at this point, okay, and price works out. Let's make it black. Price works out. The longs are in profit. The longs are in profit. Anybody that went short here, they're in loss. Okay, they're in loss. There's also a third group. The third group is the undecided. They haven't taken a position. The longs are obviously extremely happy. The shorts are extremely worried. And the undecided are unhappy that they missed out. If there's a pullback here, well, then the longs say, we've come back to the point where we made such easy money before. Let's buy some more again. This stage, the shorts have come back to break even. They say, let's get out of here before we start losing money again. They cover their positions. Okay, covering a short position is buying. So now you've got two forces of buying. Then you've got the undecided. The undecided say, we've got another chance to come in. Let's start buying. So that's what happens. But if there is a strong enough seller that pushes us down, there comes a time when the longs, the shorts, and the undecided do reverse their roles, where the longs then say, wait a second, we're wrong. Then the shorts say, wait, we were initially right. The undecideds go, okay, it's time to go short. So it really depends on how far we get away from our point. Okay, how far do we get away? The further we get away from our point of entry, the greater the understanding that the resistance or the support has fallen away. That being said, okay, we can see that it took some time. We're looking at a monthly here. It took 3 months, okay, for the market to realize that they'd overcome this resistance, because we've got eventually it's the fourth candle that pushes up. And we may have the same problem here, Kim. We may have the same problem here because we're coming to the point in time. Okay, so there is overhead resistance. There are what we call stale bulls, and of course, they may have an influence on the way the price goes. There are traders that would trade off of the resistance area. My preference is to follow the momentum. My preference is to follow the trend. I want to see it hit the resistance and see if it can overcome it. All right, so we go back down to the weekly chart, and you're quite right. We should keep a lookout here for resistance. Okay. By the way, an interesting point about resistance, and again, I don't have any proof of this. So, but W.D. Gann said resistance is overcome generally on the third test of the resistance. Okay, take that as you please. Kim, did that sort of explanation help? I'm not sure it addressed the questions that you were asking. Is there resistance? Yes. Is there trend? Yes. Are they antithesis, opposing forces? Yes. Howard just asking if we can take a look at gold. We can take a look at gold, yeah. Okay. So do we wait or do we trade? Well, our philosophy on the webinar is determine trend, determine correction, exploit correction. Okay. Then what we do is we would follow trend following indicators and see if the trend following indicators suggest the trend is long-standing or whether it's not. By the way, generally trends won't manifest 68% of the time. Okay, they won't manifest 68% of the time. Where am I getting that from? Just standard statistics. Assuming that we have a normal bell-shaped distribution, 68% of the time you're going to oscillate around the point of entry. Okay, your stop losses will take the left tail out, but every once in a while you'll get some really good trends. Okay, and those are really those are what you're aiming for. You're aiming for those gifts. Okay. All right. So statistics puts it at 34% here. 34% here. I can't remember. I think this is 13%. And then I think we come down to, I'm going a bit blank here, possibly 2% or 0.2%. All right, so this is the way your trading distribution is generally going to fall. So if we go back to, before we do gold, if we go back to the S&P 500, okay, we do a top-down analysis. Okay, we've got a bull trend here. We've got some red. Okay, something that's potentially exploitable. Sorry, I want to go. We've got a bull trend here. We go down to the weekly. Weekly says we're overbought. Okay, so we want the overbought condition to clear. Okay, so we're going to watch overbought condition and see if we can get it to clear. Go down to the daily. It's crossed down. Now what we'll do is we'll watch for the cross up. Okay. Now we're going to watch for the cross up. All right. Again, Kim, I'll ask, does that help? So do you trade at resistance? No, we don't trade at resistance. We trade at the correction down. We trade at the pullback down. Okay. Let's just do gold. All right. Again, top-down analysis. Go through to the monthly. Okay, so this is interesting. Bull trend here. Okay. Bull trend here. So the precious metal showing some bullishness. Okay. Let's go down to the weekly. All right. We're losing some synchronization here. Okay. How are we losing some synchronization here? It's the weekly's pushing down. What I suggest we do is we want all the time frames to synchronize, and eventually it's the daily that's going to give the entry or the exit. But the fact of the matter is, we'd want the precious metal to show some sort of bullishness here, okay? And so synchronization with the upper trend, the monthly trend. We don't really have that on the gold chart. So if we're losing it on the gold chart, it makes sense because dollar gaining. Okay, remember, dollar is the denominator, gold is the numerator. As US dollar pushes up, pressure's been put down on the gold price. Does that help there, Howard? Let me know. All right. Any other questions? If there's any other questions, please go ahead and type those in. Raj just saying the keys to find the bottom of the dip. Well, we'll never find the exact bottom, but we'll get pretty close. We'll get pretty close. All right. I think what we'll do is we will sign out here. Oh, wait a sec before we go. I beg your pardon. I'm just pasting the link in for tomorrow's live trade. There is a live trade tomorrow for non-farm payroll. I should have pasted it in earlier. It's in the chat now. If you'd like to participate, just go ahead and click on that, and you're most certainly welcome. All right, guys, let us wrap up at this point. Thanks very much.